It is a difference between the standard cost of material specified to the output achieved and actual cost of a direct material used. It means that the material variance is concerned under MCV, that the standard cost of material which is actually designed would be compared with the actual cost has been incurred for the material. The difference would be identified as material cost variance. Next is material price variance. It is a difference of the material cost variance which is due to the difference between the standard price of the product and the comparison with the actual price of the product. This is what the material price variance. Now the material usage variance. Material usage variance is a part of a direct material cost variance. MUV is actually determined by the difference found between the standard quantity and the use of actual quantity. So how much amount of the quantity has been used and how much amount of the quantity has been designed to be used as a standard, and the difference found will be multiplied by the standard price, that is your material usage variance. Another one is material mix variance. It is that portion of a direct material usage variance which is the difference between the actual quantity of elements used in the mixture at a standard price and the total quantity. That means it's a mixture of two things. How much standard price was actually applied and what was the total quantity of elements used at the different average price per unit of elements as the standard cost sheet. So this is all about a material mix variance, and another is a material yield variance. This is the portion of a direct material usage variance which is due to the difference between the standard yield specified and the actual yield obtained. So difference between the standard yield and actual yield, it shows your material yield variance. So the material variances we understood. Here now the labor variances. Labor variances is all about the comparisons of labor expenses, labor cost, labor rates, labor time, and many more. So one by one we will just discuss this. First is labor cost variance. It is a difference between the standard direct labor cost with the actual direct labor cost incurred. So this is a difference between the what was the direct labor cost incurred and what was your predetermined of your direct labor cost. The difference between these two, it is your LCV, labor cost variances. Next is labor rate variances. It is a part of a portion of the labor cost variance which is due to the difference between the standard labor rate specified which was predetermined and the actual rate paid. So the difference between the standard rate and the actual rate paid, that is the labor rate variances. Third is labor time variances, that is efficiency variances. It is defined as the difference between the standard hours for the actual production deserved and the hours actually worked valued at the standard labor rate work. Next is idle time variances. Idle time variances is actually comes up with the specific idle time of workers on account of abnormal causes. It means that there are certain abnormal situations where the standard time may be reflected and changed. So the wages paid for the time during which the workers remain idle due to the causes like strike, breakdown, earthquake, or the plant shutdown or certain situation are treated as an idle time variances. So idle time variances where the workers may be idle due to a certain reasons, specific reasons that reflected idle time variances. Next is labor mix variances. It occurs only when more than one grade of workers is employed and compositions of actual grade of workers are worked from those specified. So this is a difference of the labor mix variances. And there are overhead variances also. Overhead variance is broadly divided into two parts. One is a fixed overhead variances, other is a variable overhead variances. Moving to the next is reporting of variances. This is a standard costing system, maybe of a maximum value to the management. It is an essential that the report exhibiting variances from standards for each elements of cost of each department and operation should be quickly and efficiently presented to the management. So this is what all about the reporting of variances. Now, essentials of effective variance report. How it would be actually considered and how it is essential for effective variance report. Let's see. Certain points to be observed for reporting under standard costing should be considered at the time of preparing an effective report. The reports should be simple, clear and very quick. If reports fail to inform the management in a lucid and ambiguous manner of what has taken place and what actions may be taken, they should not fully serve their purpose. That means the two important thing, how it would be actually taken place, that means how this informations would be helpful and how this actually informations would be converted into a action for further enhancement. The report should present the result of the specific period and evaluate the level of efficiency achieved. The report should put forth a comparison of results obtained with the certain planning. Special care should be taken in significant variances and thereby ensuring the principle of exceptional rule. And last, variances report should be profusely make use of charts and graphs wherever it is required. So these are the essentials of effective variances report. Presentation of variances. The benefits of a standard costing will depend how quickly and in what form the variances are presented to the management, in front of the management. So the format of the variances is actually in that way that the management can immediately take an actions on that variance analysis. Although no standard form can be laid down for all purposes because of there may be certain things cannot be accepted or may be feasible for the structure and for the format of the organization. But this analysis, this presentation may be helpful for the units and organization in future whenever they want to apply it. Actual cost figures along with the variances are presented to the management in an appropriate situation. So this is what all about the presentation of variances. Moving to the next point, that is control ratio. In addition to the variances, certain control ratios are commonly used by the management for the use in controlling operations. First is efficiency ratio. It is defined as the standard hour equivalent to the work produced expressed as a percentage of actual hours spent in production. It means that the efficiency ratio would be compared the standard hours for actual output divided by actual hours worked. So how much standard hours has been used and how much actual hours has been worked, that is to be find out an efficiency ratio, and it is find out in percentage. Another one is an activity ratio. It is defined as standard hours equivalent to the work produced expressed in a percentage of budgeted standard hours. That means it is a comparison of standard hours and work produced with the budgeted standard hour. The ratio shows the extent which the production facility have been utilized as compared with the contemplated budgets. In that sense, the activity ratio is very simple to compare the standard hours or an actual hours of output with the budgeted hours. And another one is a capacity ratio. It shows the relations between the actual hours worked and the budgeted hours. So that it shows the capacity of a business, how it is actually determined and what was the situation of work. Now the last point of this unit, that is a disposal of variances. It is a differing of opinions among the accountants as regards disposal of a cost variances. How? 1. All type of variances are transferred to costing profit and loss account. That is first. The second is, if inventories are valued at standard cost rather than at actual cost, different operational statement can be made available at an earlier date. That means if you prepared this closing stock and inventories on the basis of a standard cost, then you need to prepare another statement which is actually a different operational statement, and it should be available on the particular period. The amount of variances is equitably distributed over cost of sales and stock of finished and semi-finished goods. By doing so, the cost of sales and the amount of expenses shown as an actual cost in the financial statement. So this is what all about the disposal of variances. Here the standard costing in the different topics lectures has been considered the important technique and tool for managers and for further enhancement of a decision making.